I'm going to call you the turning master if you don't mind, Milton, today.
Well, okay, might as well, but I'm not the greatest turning master anymore. Go
Well,
ahead.
this is a really difficult experience that we're going through in terms of dealing with turns, because you and I think we spoke maybe 2 weeks ago about some of the indicators that you look at, and looking at it in terms of is this the same indicator that we have for equities, or is it more of a commodity like situation? We can
Right.
talk about this in terms of the bull and bear cases for where we are right now post March liquidity crisis. But I want to sort of contextualize the whole thing on two levels. One, in terms of, what's the macro picture, but also in terms of thinking about it in terms of fundamental versus technical analysis. Because you talked to Grant on Real Vision about a year ago, and one of the things I found very useful was what you were talking about, Benjamin Graham, and that he actually at the end of his career became a technical analyst. And this is
Said
something that
no longer is rigorous security analysis necessary. Just look at published numbers, and it's all you really need.
right. And so
Technical,
talk to me about your having gotten a CFA, and then suddenly moving and saying, wait a minute, my edge is actually technical analysis.
Well, I got a CFA. I didn't know much about technical analysis, and I didn't really believe in it because I knew nothing about it. But I got my CFA. I did rigorous security analysis, but it's very difficult to get an edge. I was competing against thousands and thousands of other fundamental analysts, and there was nothing I really couldn't say that I had an edge over anybody else. And I discovered accidentally, actually, at a meeting of the New York Society of Security Analysts, they had a technician speak. It actually was Ned Davis. He didn't have Ned Davis research yet at that time. It was J.C. Bradford. I'm just fascinated by the fact that he's able to make market decisions based on data that have nothing to do with value, nothing to do with price earnings ratios. Just had to do with sentiment or momentum or monetary policy, which is really nothing to do with the individual company. So I thought that was fascinating. And then I spent the rest of my career creating my own proprietary, call it technical indicators. I like to call it market-based indicators as opposed to fundamental or value-based indicators.
And when I watch the financial news, at the end of the day, they say the market was up or the market was down because of X, Y, Z. But is that really how it works when you think of it from a technical analysis perspective?
Well, let me just give you an idea of why it's so difficult to say the market moved today because of X, Y, Z. Let's assume there's a large pension fund, $100 billion sovereign fund, that wants to invest $5 billion in a stock that has a market cap of $30 billion. They can't do it all in one day, right? It's going to take them 1 week, 2 weeks, 3 weeks, or 4 weeks. They're going to put a program to buy stocks. The news that takes place that day will not affect whether they buy stocks or not. They just have to buy the stocks. They started their program. They will continue. That is just one piece of evidence that suggests that you can't really blame the daily market moves on the daily news. There's so many other factors involved in the supply and demand picture in the stock market. Very often there's a shift because consultants are telling you shift out of stocks, out of bonds into stocks. Institutions can't shift in one day. They're going to shift over 3 days, 4 days, 5 days, 6 months. And that's going to cause a trend. To suggest that, like the monopoly theorists do, the daily movements are based on daily news is really very far from logical.
Yeah, and so I mean, for me, that's where technical analysis comes into play in terms of when we're thinking about what's going on during this global pandemic and the reaction to it in terms of fiscal and monetary policy. From a fundamental perspective, as I was telling you before, the way I'm thinking about it is, we had a panic. The Fed staunched it out in March. We went into this lockdown. The economy went through a dive. The Fed came guns blazing, and now the market's responded and is up, almost 50%. The question is this a new bull market, or is this just a bear market rally? And that's the question everyone has, and I want to talk to you about that from a technical analysis perspective. The first question, obviously, and I think that you told me this before we got on, is about the Fed. It's about policy. What's going on there that's driving any of the action in the marketplace?
Okay, well, Let me talk about the long-term action before we discuss the short-term action.
Okay.
It is common belief amongst Wall Street that the Federal Reserve has the ability to raise stock prices. If they lower rates, they do quantitative easing, stock prices go up. Now let's look at history. The Japanese have been involved in quantitative easing for 30 years, 40 years. The Japanese stock market peaked in 1989, has never made a new high. But let's look a little bit closer to home. The Chinese stock market in US dollar terms peaked in 2015. China has been easing. In local currency terms, it peaked in 2007. Greece is down 90% from its peak in 2007, despite the fact that the European central banks have been doing, I think they said anything it takes to goose the markets and to goose the economy. United Kingdom peaked in 2007, is down 43% in US dollar terms. Italy peaked in 2007, is currently down 61% in US dollar terms. So to suggest that the Federal Reserve, central banks have the ability to create bull markets is very, very strange. We are in a major worldwide bear market that basically began in 2000, secondary top in 2007. We have yet to recover. And even looking at our market, we're talking about a new bull market. The S&P small cap index peaked in 2018. As of yesterday's close, is down nearly 19% from its peak in 2018, which is 2 years ago. So the Federal Reserve has been easing and quantitative easing. So on a long-term basis, there's very little evidence that long-term bull markets are coincident with loose monetary policy. There are many other factors involved other than Federal Reserve easing. On the other hand, when the Federal Reserve makes a major change in policy, in other words, they go from tightening to easing, or they go from easing to more easing, that serves as a shock to the system and bulls or gooses up stock markets for a short period of time. But I do not believe that the Federal Reserve movements have a true long-term effect on stocks. In other words, when the Fed eases, the same factors that get the stock market to rally are the same factors that get the economy to rally. If the S&P, if the Federal Reserve eases, as they just did in 2020, and the stock market therefore rallied, but if it doesn't follow through with the gain in the economy, the stock market will not continue higher because the Federal Reserve does not have a direct ability to goose the stock market on a longer term basis. So what we have is step one, the Fed panicked, the Fed eased, the Fed increased the balance sheet to what is it, $9 trillion. The markets rallied. Will this affect the economy? We don't know. I tell you, I'm very confused by the following. Interest rates are at record lows. Interest rates at record lows are suggesting that the markets don't expect inflation. And on the other hand, when the Federal Reserve increases the money supply and the Federal Reserve increases its balance sheet, they're trying to create inflation. Gold and silver are rallying in anticipation of that inflation that the Fed is creating. Well, if the Fed is creating inflation, why would the long-term interest rates be 1% or so? It should be up 3, 4, 5%. So there are some conflicting factors going in the markets today. We're trying to analyze it. We're trying to figure it out. The most likely answer is that off the March lows, the shock of the Federal Reserve and central banks rolling, doing what they do, gave liquidity into investors' hands. So anything they buy is going to go up in value, be it bonds, be it stocks, being it silver, be it gold, be it junk bonds. That will not last forever. The only question is, what will the next turn be? Will it be a deflationary turn where silver and gold go back down, stocks go back down, and yields remain low? Or will it be an inflationary turn where yields start turning up and stocks continue higher and gold and silver continue higher? And that's the kind of information we're looking at and we're grappling with at this point.
Right. I think that's a great summary of where we are. And now we can start looking at some of the charts and you can explain some of the technicals that might tell us, what the answer is. Because when I look at some of the charts that you sent me and that we're going to talk about, the date that stands out in my mind is June the 8th. June the 8th, 2020 is a date on a lot of those charts. And that's in the past. That's two months ago from now. So
right.
Talk to me about that date. Why does that date matter?
Well, let's talk about June 8th. Let's just look at market action since June 8th.
Okay.
The S&P is up 2.88% since June 8th. Not a great move. It's made a minor new high. The Dow is down 1.16%. The New York Stock Exchange is down 1%. S&P small caps are down 2%. Mid caps are down 1%. UK is down 8%. Russell is up 0.7%. The CAC in Paris is down 6%. The Nikkei is down 3.55%. So while it feels that the markets have been breaking out because these great FANG and NASDAQ stocks are up 9% since June, in reality, most markets worldwide and most stocks worldwide somehow peaked on June 8th. Now, what took place on June 8th to get the markets to peak? Well, one thing you have to realize is that the Fed balance sheet peaked on June 10th. I don't know if people are aware of that. The Fed balance sheet is down nearly $300 billion from its peak on June 10th. So while the Fed is trying to talk the market up, talking about expanding the balance sheet, the reality is they expanded the balance sheets from March to June 10th. And subsequent to June 10th, the balance sheet is slowly declining. It doesn't have to decline, it's just not increasing. And I think that's having a direct effect on markets. As they said, on a short-term basis, Fed action does move markets. And if the whole movement in the capital markets were based on a loosening Fed, where the Fed stops loosening and even the balance sheet just stops growing, it goes down some $200, $300 billion, that's enough to peak market. That's number one. But number two is, you saw something else on June 8th. A tremendous, and when I say June 8th, it's not necessarily that date, it's June 8th, June 10th, June 11th, it's sort of mid-June. So tremendous speculation in markets. Let me give you an example. We studied all market crashes, panic-like crashes in history. Now, we had one in March. I say we had one in March because the NASDAQ declined some 30% in about a month. NASDAQ 5-day volume was its greatest in history. And that sort of compares with the type of crashes we saw in 1987, where the market was down 32% in a little bit over a month, with the highest 5-day volume in history. And so too in 1929, the market declined some 50% over a short period of time. And it bottomed basically with the highest 5-day volume in history. Now, let's look at the highest 5-day volume in history. The 5-day volume in 1929 remained record for 32 years. The 5-day volume in 1987 remained a record for 8 years. The 5-day volume into the so-called crash, so-called capitulating panic in 2020 has lasted for 3.5 months. Because on June 8th, that period, the week of June 8th, NASDAQ volume was 30% greater than it was, 5-day volume was 30% greater than it was at the lows. Now, how can we even say we had a capitulative low in March if one of the greatest signs of a low is panic volume when you saw greater volume to the upside? I'm interpreting to suggest that you're seeing panic volume to the upside, which we call capitulation to the upside, which is something very typically seen in commodities markets. Commodities markets don't bottom on high volume. Commodities markets generally peak on spike action and high volume. And that is the reasons for it. We don't have to get into the reasons at this point. But basically, let's just say that people are forced to cover shorts in commodities, and people are so excited about there'll no longer be oil in the ground, peak oil, or there's, silver is there's no more supply for silver and so on. So it forced them to buy the commodity. I think we saw that in NASDAQ. I think this FANG craziness, where the value of the 6 greatest stocks in NASDAQ is greater than all European indexes combined, plus Mexico and Canada. You take the value of the Canadian index, the Mexican index, and all European indexes, combine them, you have 6 stocks in America that have a greater market value than all those markets. So I think this is a commodity type move in these stocks. Yes, they're great companies, and yes, they have great earnings. But, RCA was the great story in 1929. It was a great company with great earnings, a great future. They made radio. Ultimately, they made color television. That stock didn't get to a new high for another 25 years. I'm not suggesting we're having that type of situation. I'm just trying to say people are caught up in NASDAQ as evidenced by the great increase in 5-day volume. But it's not just NASDAQ. The S&P Small Cap Index generated its highest volume in history in the week of June 8th.
Right.
And that was 39% greater than the panic volume we saw at the March lows. There's something going on in this market that is not normal, is not being recognized. Now, one can argue, and it's a very common and logical argument, that this volume is breakaway volume. This is a volume suggesting that a new bull move is beginning. For example, in January of 1987, we saw the highest volume in history on a 5-day basis as the market was breaking out of the trading range, gaining 30% to its final high in August. But we're not seeing breakaway action. I started this interview listing all those indices that are still below the level of June 8th or just slightly higher than the level of June 8th. We're not seeing breakaway action. We're actually seeing reduction in advanced decline indicators. We're seeing the peak in the 10-day AD line took place on June 8th. The peak in the 30-day AD line took place on June 8th. The peak in 12-day volume took place on June 8th. And what's following through is rather than a breakaway is actually correction. I'll give you an example. The S&P Small Cap Index declined 14% in the 2 weeks post June 8th. The Dow declined 9%, and the Russell declined 13%, and the S&P declined 7%. So you didn't get the follow through you see when you see this type of volume. That volume is tapering off, which is really suggestive that that was probably what you call it the internal peak of the market. It was happening since then, may well just be testing highs. I'll give you a great example in history. On March 24th, 2000, when the S&P peaked and the NASDAQ peaked roughly the same day, not quite the exact same day, took place on the highest volume in history. The market ultimately, 6 months later in August and September, tried to make a new high. The S&P got within 1% of the high in March. Never broke out and it failed. NASDAQ didn't get that close to the high, but the New York Stock Exchange Index made a minor new high in early September of the year 2000. We're seeing similar action now, where the market made a peak in February. S&P is within 2% of its peak. Everyone's so excited about it. The Dow is significantly below that. The Russell 2000, as I said, is way below that. The S&P small cap is 18% below where it was in 2018. So this to me looks like bear market action. The volume we're seeing is commodity-like. The volume we're seeing is speculative. I'm not as convinced as everybody that the Federal Reserve is going to be able to goose the markets any higher. And in fact, let's face it, I think there's some rational space in these guys' brains. I think they haven't turned our money into Wampa money. I think they're trying to convince themselves that they're doing is rational and what they're doing it makes sense. And I don't think Mr. Powell is going to turn our republic into the Weimar Republic with hyperinflation or Zimbabwe. I think he's going to restrain himself somewhat. I think when he talks about we're not even thinking about raising rates, what he means to say is until the data tells us that there's inflation or economic growth, we won't raise rates. But that's fine. What he's saying is we'll get a deflation, we'll get a depression, and I'll be lowering rates. That's fine. But he's conceding to the fact that we could get a depression and deflation. He's not saying we already have this market under control. He's not saying we have the economy under control. He's actually saying the opposite. We're not even thinking about raising rates. Why is he not thinking about raising rates? Because he's aware of the fact that most likely the COVID decline is not a temporary decline. It's not like the bunker hunt silver market declined down 27% in 3 or 4 weeks because of the silver crisis. It's not like the 1987 crash, which really wasn't fundamentally related. It was technically related because of program trading, maybe because interest rates were up a little bit. It's more like the 1929 crash, where the market is anticipating depression. Now, the depression may have been caused by governments. I think it makes absolutely no sense to lock down the world. But let's say it did make sense. It's irrelevant. This is just politics. Let's say it made sense to lock down the world. Locking down the world is a very drastic measure. We've never done it before. We can't predict that the outcome will be positive. We can't predict there'll be a V recovery. And we can't say that the stock market is telling us there'll be a V recovery. Because in 1929, the S&P 500 gained some 46% in 101 days. And then it led to a bear market. We've gained some 48% through yesterday in some 90 days. And if it didn't tell us in 1929 that the market's going to clear higher, it's not telling us the same information now as well. It was you're up 46% in 101 days in 1929, 48% in 94 days currently. And guess what? I read the newspapers in March of 1929. The bulls were stating Fed is lowering rates and fiscal policy is stimulative. And guess what we're saying today? Fed is lowering rates, fiscal policy is stimulative. That's true. Does that mean that the world shutdown, which is continuing, is not going to have a dramatic effect, long-term lasting effect? I don't know. Delta Airlines doesn't believe it won't have a lasting effect. Neither does some of these banks who have loaned money to people who can't pay them back. Neither is the 30 or 40% of the Russell 2000 companies that can't, that aren't showing earnings and really can't meet any debt payments if they have to make debt payments. So I'm sort of pessimistic on the technical side and even somewhat on the fundamental side. And it hits me that the markets basically peaked along with the balance sheet on June 10th of 2020.
Very, very well stated in terms of the bear case, and but I know that that you have an even-handed look at this as well, because the first chart that you sent me I thought was really interesting was the buy indications in June and July of 2020. In terms of the S&P 500 5-day breadth, the S&P 500 60-day new highs.
Right.
the NYSE 12-day net up volume as a percentage of total volume. Can we go through some of
Yes.
these and
Yes.
talk to me about what these indicators would
Yes.
say and why perhaps some of them are telling you the opposite, that wait a minute, here is the bull case, so to speak.
Yes. Well, let me just tell you, be very frank and very honest. We have a proprietary database of over 30,000 indicators. We've tracked every bull and bear market since 1928 in the S&P 500 and other markets as well. We have never seen the type of decline we saw in March of this year. The type of oversold indicators that create bottoms did not create a bottom. They started sealing in February. The oversold indicators that create bottoms started sealing in February. It didn't work. We've had 134 buy signals since the March 23rd lows, 134. To you, when I sent you the chart, I was focused on the 17 that took place since June. But we have 134 buy signals, and I can't say I acted upon these buy signals properly. I can't say I analyzed my data properly. But I would say that based on the momentum of the market, based on the type of action off the lows, this is the kind of thing, this is the kind of action that takes place early on in bull market moves. No one can doubt that. Look at the lows off the 1974 lows. Look at the lows, look at the market off the 1982 lows. Look at the market even after the December 1987 lows. This type of action, upside action, is type of action that takes place early on in bull moves. I'll be a little bit more specific, and I will try to tell you why I'm skeptical. Let me just tell you one reason I'm skeptical.
Okay.
There's a very famous indicator that many people use. We have 12 versions of this indicator. Most people use one version, and that is the 10-day breadth thrust. What is a 10-day breadth thrust? You look at, say, the New York Stock Exchange Index. You see how many stocks are up on day one, on day two, and how many are down, day 1, 2, for 10 days. So you look at the 10-day breadth thrust. The New York Stock Exchange on June 5th had 1.9 to 1 upside breadth over a 10-day period. That's taken place 17 times in history. Of these 17 times in history, the median maximum return over the next 12 months has been nearly 25%. Now, just to give you the facts, on a random daily basis, the median maximum return in the S&P 500 over the next 12 months is 13.61% on any random day. So by virtue of the fact that this one indicator with 17 historical instances has shown a median maximum return of nearly 24%, tells you this is a very potent indicator. However, there's something very strange about this signal. This signaled on June 5th. The market bottomed on March 23rd or so, right? So you have March, April, May. It's 2.5 months from the time of the market bottom until you get this breadth thrust. Well, lo and behold, I looked at the 17 instances in history, and most of them, the majority of them, 90% of them take place within 2 weeks of the low. A 10-day breadth thrust takes place within the first 20 days of the low, sometimes within the first 9 days of the low. We got a 10-day breadth thrust 9 days after the December 2018 low. Now you got the 10-day breadth thrust into a June 8th peak, or June 5th. This is telling me commodity-like action. This type of upside pressure should have taken place off the low. In this case, this upside pressure took place after the market was already up 50% in some indices. Very, very strange. So it's a bullish indicator, yet I'm skeptical. Now, I always try to teach myself, just follow the indicators, don't be skeptical. The problem was that the March decline was very atypical. The February March decline was very atypical. I saw many indicators that worked in the past on the downside not work. And now I'm seeing commodity type action. I'm seeing indicators acting different than they should act. Anyway, that's one indicator which I suggested was very bullish. It is very bullish. I can't argue that it's bullish. I'm trying to give a caveat. This signaled not within 2 weeks of the low. It's actually signaled 2.5 months after the low. Very, very, very strange. It's more likely commodity type speculative action.
And talk to me then about why it is that you think, because I think the way that you were putting it is that in commodities, you see high volume at the highs.
And high momentum at the highs.
Exactly.
The greatest momentum takes place off the lows. They used to call it the glory points, the first 5 days of the low. When I was doing the business, they called it the glory points. Markets up 5, 6, 7, 8, 10% first 5 days of the low. Commodities are just the opposite. Look at gold and silver currently, right? Gold and silver are showing the greatest momentum now after the market has based for 6 months. Commodities act totally different than stocks, and now stocks are acting, in my opinion, like commodities.
Yeah, and so the question is why is that? What do you think has happened to the market structure that would cause stocks to suddenly act more like commodities than
Well,
equities?
I could blame it on the Fed, partially, but you gotta have to blame it on psychology. Basically, we've been taught and we've seen that anytime the market goes up, down, it goes right back up. We've been taught by dips. We've been the Fed has been our put. We even created products that would have been unheard of decades ago. ETF products, leveraged 3-to-1 ETF products, VIX trading products. I mean, we create products. I mean, I'm a free market capitalist. I don't believe you should have the SEC monitoring what kind of instruments are created. But I also don't believe that the Federal Reserve should buy ETFs or try to bail out junk bonds. So we have a very, very, very strange situation where the capital markets have created leverage types of ETFs. The banks have in derivatives up to kazoo. People understand stocks as pieces of paper or just chips on a computer, as opposed to real companies that have to do something for you, pay you a dividend. Dividends don't count anymore. You know, we used to look for 5, 6, 7% dividend stocks. Now, if you're yielding more than the 0.6 of the 10-year Treasury, you're considered a high-yielding stock. Things have changed. So I think what's created to commodities is both the new structures and new programs, ETFs. With one click of a button, you're buying 500 stocks or 1,500 stocks. And the fact that psychology tells people not to worry about individual companies, just look at the markets, and if it comes down, it's going to go back up. And it's probably more information than I can figure out, but it's definitely acting commodity-like. And my indicators, it's reflected in my indicators. I'm seeing so many more signals, for example, off the March 23rd low, than we've seen off any other low in history that we've tracked. Again, we tracked every low in history. We're seeing more buy signals now. We've seen the same signals in the past, but some signaled in 74, some signaled in 82, some signaled in 62. But now we're seeing all these signals taking place within a 3 or 4 month period. Something is very, very different. You can argue that it's very, very bullish. Now, I can give you the bullish argument, and this is something troubling me. Maybe we are heading for a Zimbabwe. Maybe we are heading for a Weimar Republic, where you have to own stocks and you have to own gold and you have to own silver, but you certainly don't have to own long-term treasuries. So there's reason to think we may be headed hyperinflation. I personally believe that the risk is still deflation. I believe the Federal Reserve understands the risk is still deflation. But if we're headed for that type of hyperinflation, then the stock market will become commodity-like. And this type of volume we saw will not top the market, even though it's greatest in history and it's 30 to 35% greater than it was the March lows. This is just the beginning of a long, extended hyperinflationary move. I don't buy it.
Well, the one thing that you said that really had resonance for me in terms of the psychology there was something that points to passive investing for me. That is that, irrespective of what happens in the market, there's a flow, there's a bid into the market as a result of people buying the dips, for their 401ks, et cetera. Mm-hmm. How much do you think that contributes to the potential commodity-like buy signals that that you're seeing?
Well, it's interesting that you bring this up. People who buy on a program, meaning every April they put their 401k money into the stock market, these people cannot turn them into commodity-like. It's actually the people who trade on the margin. People are looking at the stock market as a way to make money, as a way to outperform the market. These are the people that create a commodity. It's not the producers of copper, and it's not the consumers of copper that turn copper into commodity with major swings. It's not the consumers of sugar. It's not the producers of sugar. It's the speculators that want to capitalize on these moves. So I don't believe necessarily that it's the 401k type investor turn commodity. I think it's people thinking or being convinced that anytime the market goes down, it's going to go up, and anytime it's going to go up, it's going to go higher. And even if you get a correction, even if it's 30%, which we had in March, it's going to go right back up. I think the speculative juice is flowing. And interesting, I mentioned speculative juices, and in this argument, because we've also seen something very interesting in June, which is very, very surprising. And that is the 10-day put call ratio. Now, a put call ratio basically tells you when people buy puts, they're expecting the market to decline. We buy calls, they're expecting the market to rally. It's a very short-term instrument, very speculative. And normally it's sort of a balance between call buying and put buying. But this year on June 23rd, put call ratio, I believe, was the low. Yeah, it was 0.43 on a 10-day base on July 21st. Lowest reading since September 7th, 2000. Speculative juices. Put call ratio is low. They're buying calls rather than puts. Now, it's interesting. I said it's the lowest reading since September 7th, 2000. As you know, the New York Stock Exchange made its final bull market peak that week, the first week of September 2000. And we're seeing the same type of put call ratio now that we're seeing then. And we have a very similar market now than we had then. Then you had a crash in NASDAQ in March and April, and then a recovery. You had and I can't say a crash in the S&P down 14%, but then you had a recovery in September. And we have the same situation. We had a crash in March, and we have a recovery, new highs in NASDAQ. And people are so convinced that it's going higher that the put call ratio is back to where it was in 2007. So there are a lot of speculative juices flowing, and people are arguing, that there are some sentiment indicators that are suggesting people are negative. But I clearly see positive sentiment, not necessarily on the part of hedge fund investors, not necessarily on the part of the typical retail investor, but the people who are out there trying to find a place to make money, are throwing the money into the stock market, into ETFs, into leverage ETFs, into gold, into silver, and even into bonds and junk bonds. So I still think you have that commodity-like flavor in this market. Again, we could be wrong. These speculators could turn out to be right. And
something that you said was interesting with regard to what I would call bifurcation in the market. We've been talking about this a lot on Real Vision. You mentioned the 10-day breadth in June, that indicator that this was a number that if you look out, I think it was 20 months that you said you had an average return of 24%. But earlier in the broadcast, you were talking about the June, the global indices from June. Actually, on average, they're down. Only the NASDAQ that you quote had a considerable uptick.
Only considerable uptick is NASDAQ, right? Which is very non-typical. There's another indicator we look at. This is there are 17 instances where the 10-day advanced decline line gave a buy signal going back to early 1970s, and it's a very potent signal. But there's another signal I have, which looks as 12-day upside volume. 12-day upside volume. Now here I actually have the table. I'll find it in a minute. 12-day upside volume versus downside volume gave a signal exactly on June 8th. Historically, it only happened 5 times in the past. It's been a very, very, very potent signal. And I give you the statistics. The market has gained median maximum gain within 12 months of 25.04%. The maximum drawdown in all 5 historical instances from the date of the signal was 0.79%. So when you have a 12-day upside volume versus downside volume, and an exact statistic I don't have it in front of me, I think it's a net reading of plus 40%, but that's not really important. Important is a very rare indicator. It's signaled 5 times in history. The median maximum gain within 12 months is 25%. It never had a drawdown of more than 0.79%. In this market, Russell declined 13%, small caps declined 14%, Dow declined 9%, S&P declined 7%. Only the NASDAQ did not decline; it continued higher, and the worldwide markets basically peaked. Many of them peaked on that date, and the AD line peaked on that date. In other words, although the NASDAQ's at a new high, the advanced decline line and the New York Stock Exchange equities only is not at a new high. So it's kind of strange. I think I'm making my case a little bit clear that although things look bullish, maybe they're not as bullish as they seem.
Yeah, I think you are making it, and let me see if I can sum up how I'm thinking about it now that you've presented the case. So we had a panic in March. The Fed came in guns blazing as a result. That had a short-term impact as it has done in the past, but that impact it crested in the beginning of June. Their balance sheet has rolled off since that time, and interestingly enough, at that exact same time, suddenly a plethora of buying indicators came forward. But the price action since that happened has not been in accordance with prior price actions that we've seen. The drawdowns have been larger than you would see in previous past. And so as a result, you're looking at this as not the typical bullish indicator from June, but rather as a commodity-like bearish indicator, and that in all likelihood, we're going to see another leg down to this market.
Yes. Well, and I would say that some of these indicators that signaled in June should have signaled in April. In other words, these advanced decline thrusts, these volume thrusts, the double 9 to 1 day thrusts, is another great indicator when the New York Stock Exchange upside volume versus downside volume is greater than 9 to 1 for 2 days in a row. In our case, it was 13 to 1 and 30 to 1. That is signaled 7 times in history. The median maximum gain within 12 months is 25.54%. But these usually signals coming out of a consolidation or right off a low, within 2 weeks off a low. It hasn't happened. It didn't happen until June. Why? Something is different. Something is very, very different, and I'm skeptical. Now, I wouldn't say, you use the term, it's most likely the market's going to have another leg down. I wish I could say it's most likely. I'm having difficulty in assessing probabilities. Looking at the data alone, looking at the buy signals alone, you'd have to say probabilities are the market's headed much higher. Looking at the 134 buy signals we have since March, I'd say the probabilities are that we're going to get out of this recession. We're going to have an amazing booming market. We're going to go up 25, 30, 40% over the next 12 to 18 months. That's what you have to say based on the indicators. But I don't want to fight my indicators. But I've been in the business a long time. I know what the Fed does. I know what the Fed tries to do. I know how the economy works. I've seen panics before. I see panics. I'm going to give you a great example of a panic. The great President Jimmy Carter, one of the first things he did in office is put on a sweater, and he told everyone to lower the thermostats. You want to save energy. That was, if you recall that.
Yeah, I do.
Second thing he did in office was he asked the U.S. citizens, please, please, please stop using your credit cards. And of course, at least half the country that voted for him stopped using the credit cards. And the market had a mini panic that lasted for 2 weeks. I think took the market down nearly 25%. Congress basically said, no, use your credit cards. We want you to use your credit cards. And the market went right back up. This is not what happened with COVID-19. The government shut down the economy. They're still talking about, especially I don't want to make it political, but at least half the country that didn't vote for our president wants to shut down the economy. And there's no V-turn. You can't just turn an economy on and off on a dime like that when you're going to do total lockdowns. You could do it, don't use your credit card, and then use your credit card. That'll be a V recovery. I look at it as on a free market, you give the information to the people. Now, at first, in March, we didn't know what kind of crisis we had. We were convinced, and I myself was convinced, that 2 million people in the United States will die within 3 months. That was some of the indicators were telling us. But now that we've had 3, 4, 5 months of this crisis, we should be able to stop this idea of total lockdown. I don't want to get political, and say there are ways to prevent the elderly and the infirm and people with existing conditions. They should wear masks. They should be isolated. They shouldn't go to work. But you have to keep an economy going. And that's just my view. But basically, I don't think you just shut it down and turn it back on. It just doesn't look like it anymore. And there's another reason for that. The Fed did just the opposite of what they should be doing. Excuse me, not the Fed, the fiscal authorities, the government, did just the opposite of what they should be doing. They created increasing debt. Debt is the poison of the economy. In other words, this crisis, instead of liquefying people say, hey, how am I going to liquefy my balance sheet to save myself from further deterioration in my financial situation? The government says, no, $3 trillion, we're going to borrow this money. And this can't have a positive long-term effect, although it could have a positive short-term effect. So as you see, I'm not pounding the table either way. I wouldn't say it's most likely we have a correction. I'm not pounding the table either way. I think COVID is a very serious crisis. I think people have to protect themselves. I don't think that the methods used by governors and by mayors were the best, the optimal methods. I understand why they did that initially. I don't understand why 4 months into the crisis, you can't sort of cherry pick on who to protect and who not to protect. I don't know why we can't do that. But in any event, I'm not that convinced that you can have a V recovery. You had a V recovery in stocks, seemingly, although that is also doubtful because, as I said, looking at worldwide markets, markets peaked in 2000, 2007, 2018. The 5, 6, 7 stocks in the NASDAQ have a greater market cap than all European stocks, including Mexico and Canada. And I don't believe that we're really in a healthy environment. I think we're in a stealth long-term bear market. I think the benefit that has to be given to the negative side. And right now, markets making some is making new highs. It's difficult to make this kind of a call. But at least what I do to my clients is I try to give them both sides of the story. I give them my buy indicators. I tell them why I'm negative in the market. I tell them why this kind might be different. Maybe my judgment and whether to go long or short might not be correct, or maybe it will be wrong. But my clients should be sophisticated enough to see this indicated as the viewers of Real Vision understand that not everything is always black and white. I'm a black and white type of guy. I like to make clear-cut decisions. The market's going to go up, the market's going to go down. It's not that clear-cut at this point, but I do believe that the consensus is that the Fed saved the economy and the Fed saved the markets, and we're going to higher. And my view, based on my understanding of markets, understanding of the Fed, understanding of the economy, is that we're going to creep further into a deflationary crisis. The more debt's outstanding, the more deflationary things become. You can kick the can down the road another 3 months. Maybe Congress today will pass another stimulus package, which is just another temporary measure. Rents still have to be paid, wages still have to be paid, people still have to pay down the debt, students are going to pay down the loans, and if they don't, it'll be deflationary. Unless the Fed actually prints, literally prints like they did in Zimbabwe. I'm talking about literally prints using printing presses like they did in Venezuela, and then you can hyperinflation. But if you just create debt as a method of printing, it doesn't work. And the proof is, look at Japan. They've been creating debt since 1989. They have the greatest debt to GDP ratio in history of any country, and their market peaked in 1989. Look at the European markets, peaked in 2000, 2007. Well, Mario Draghi says, I will do whatever it takes. He's done whatever it takes, but it hasn't been really sufficient because you really have to have an economy grow from the bottom up through capitalist system where people go to work, people get jobs, people invest their capital, as opposed from the top down where you just throw wampum money at economies and expect economies to grow.
Well, to be continued. We'll have to see how this pans out. I agree with you 100%, Milton. It's hard to say where we're going to go from here based on the technicals, based on the fundamental factors. But I really appreciate your coming on and talking to us and walking us through your analysis. Come back again.
I had so many more things to talk about. We'll have to do it again. I know.
Right, definitely.
If you're ready to go beyond the interview, make sure you visit realvision.com, where you can try Real Vision Plus for 30 days for just $1. We'll see you next time right here on Real Vision.